what is amazing about crypto is it is all interoperable. And so as long as there's liquidity on the source chain, on the place where the initial currency exists, and there's liquidity on the destination chain where you're trying to move the funds, you can swap between them remarkably easily and, again, permissionlessly without any sort of central intermediary. There are these decentralized exchanges called Uniswap or 1inch or whatever it is that allow you to facilitate these transactions, and you can do it all programmatically.
Welcome to the Galileo Financial Technologies Podcast. I'm your host, Scott Henderson. We're here to delve into the thrilling world of fintech and banking, exploring the latest trends, innovations, and disruptions. Every episode features insightful chats with industry leaders and visionaries who are pushing the boundaries of finance and banking. Whether you're passionate about fintech, running a startup, leading a large bank, or just intrigued by financial technology, this podcast is your go-to source for staying ahead. Let's dive into the future of finance and banking together.
I am Prashant Shah, VP of Product Management at Galileo. I lead the product for issuing processing on our platform, and I'm here with Justin Gainsley. Justin, why don't you tell us a bit?
Yeah. Hi, everyone. I'm Justin. I lead payment products at Coinbase. I've been at Coinbase for about 3.5 years, majority of the time working on our payments business. And when I took on our payments business a few years ago, crypto payments really were not a hot topic. At the time, we were what we consider a venture bet internally, which means it's a very small team. It's very much a moonshot and looking to find a need, looking to solve a problem. And when I took on the business, it was really 2 kids and a laptop was our customer. And a lot of people interested in Bitcoin payments in particular, looking for a marketing moment, things like that. And it's been amazing over the past year to see just this explosion in demand and utility with stablecoins in particular. Stablecoins truly are one of the best payment rails. I think we can attest to the compounding innovations that we've seen in crypto over the last many years, the last decade, to make stablecoins remarkably cheap, remarkably fast, global, permissionless, programmable, all these great attributes that make them a fantastic payment rail. So we now have a large payments business at Coinbase. We have payment acceptance, pay-ins, payouts, B2B, treasury, really the full life cycle. And it's been a pleasure to get to work on that. And it's exciting to be in rooms like these where stablecoins are now top of mind.
Absolutely. And I know before we get too much into stablecoins, why don't you tell us a little more about your journey to Coinbase? I'm sure people will be interested in that.
Yeah. So I started at Coinbase in 2022. We had just entered a bear market, and so it was a little bit of a bet on the industry that we were going to be able to build products that people ultimately loved, that the industry would come back with force. Prior to Coinbase, I'd been building a non-fintech social startup for a little while. And before that, I was in college. And so I'm fairly new to the working world, you could say, but I think what's fun about crypto is 1 year in crypto might be 5 years somewhere else. And so you learn a lot really quickly.
Absolutely. So what interested you in fintech? After studies, like you said, you went into social networking, and now what made you jump over to fintech?
Yeah, what excited me about crypto in particular is it felt like such an enormous step function innovation in money, and it had not yet found that product market fit on where people were actually going to solve problems with it. I think there was a lot of infrastructure build out, a lot of kind of internal baseball, a lot of people in crypto buying each other's products, being excited about what we were innovating on. But it wasn't until recently that people really started building for use cases, building for utility, and finding these opportunities to really improve lives and solve problems with this underlying technology, whether or not you really know what technology is there. And so that was what I was excited to ultimately pursue. It felt like something I was very curious about, and I try to follow my curiosity. And ultimately, we landed in a place where people are excited about it, and we can finally really solve problems for the mainstream.
Absolutely. So one thing which always intrigues me, right? Like you said, there was a lot of infrastructure which has been built over the past decade or little more than a decade now. But if you look at other payment rails which have always existed, there's a lot of infrastructure already built for that, and it's being enhanced, right? One of the big things about stablecoins, crypto, is the 24/7 nature. And Fed is getting into it with Fed Now and so on and so forth. So what do you think about these Are these competing with each other? Are these going to coexist? Is there a convergence? What are your thoughts among the traditional TradFi versus the new rails?
Yeah, I think coexistence is the key word there. Right now, what we are excited by is adding stablecoin as another payment method, whether it's at checkout, whether it is for payouts, whether it's B2B. Having it there is serving this latent demand that someone in the world wants to fulfill. And so with checkout in particular, where I spend a lot of my time, we just want USDC to sit there alongside cards, to sit there alongside Pay by Bank. It's not that we need to cannibalize or be number one in market share versus fiat today, but by adding it, we're noticing that merchants are now receiving payments from customers who might otherwise not have paid. There's tens of millions of people, maybe 100 million plus now, who hold stable coins, who earn in stable coins, who want to spend stable coins. And by enabling that at checkout, merchants are now seeing increased volumes, a more global customer base, customers who otherwise might not have paid. So that's what we're seeing when it comes to latent demand, is whether it's payouts in a business or a contractor wants to be paid in a dollar-backed stablecoin, whether it's a business that wants to transact in stablecoin. I think having it there alongside coexisting and actually growing the pie of payments largely is how we'll see it play out over the next few years. Of course, I think there's a world where many of our payment flows settle on stablecoins. It is a faster, more global rail, but I don't think it has to come at the expense of just business efficiency broadly.
Got it. So definitely reach is what you're talking about, and reach is expanding. It's going from just your local customers to cross-border and people who may not have the same currency available. What other use cases are you seeing where stablecoin is seeing really the J curve in adoption?
Yeah, so the borderless nature is by far number one. People just love the fact that they can tap into a customer base in any country in the world. I think it's an amazing kind of step function improvement in money that anyone with an internet connection can now transact. And with our integration with Shopify, for example, at checkout, that's a lot of what we're seeing. Cross-border is by far the number one use case. But of course, there's some amazing other attributes of stablecoins. For example, 24/7, 365, there are no banking holidays, there are no cutoff windows. This money moves like water instantly in 250 milliseconds. And so we found that for buyers we see a lot of opportunity where in treasury, in B2B, where people are using stable coins to improve liquidity, to more efficiently transfer money, to avoid the pre-funding dilemma that a lot of businesses face. So that's one in particular. And then another one that I think is really exciting about stablecoins is there is no maximum and there's no minimum transaction size. And so we're actually seeing now AI agents transacting sub-cent using stablecoin rails, which could never happen with traditional fiat. And so truly, these AI agents are pinging for a data source. They're paying on the spot using a protocol called X402, and they might pay a tenth of a cent. And that's uniquely enabled by something like crypto. And whether it's a tenth of a cent or tens of billions of dollars, you can do all of these transfers for extremely little cost in real time, 24/7. I think that's anywhere around the globe.
No, absolutely. Reach is increasing, use cases are proliferating, so definitely. Now, as you enable this, how do you think about compliance? Because definitely the sender, the recipient, you need to know who they are. Now, yes, there is an ID which is tracked in blockchain, but how do you cross-verify those against, the traditional compliance, right? KYC. Is this really Justin, or is this really Prashant, or is this someone else?
Yeah. So the way we think about compliance is in opportunities where we can maintain the status quo compliance, where we can do what is typical in Web 2 and fiat, we absolutely should. And we should separate kind of the payments layer from the identity layer, do the necessary KYC, KYB, AML, whatever you need to remain in compliance. And Coinbase is probably the most trusted brand in crypto. We service the biggest brands in the entire world, the biggest governments in the world. And so compliance really is at the forefront of anything where there is a Web 2 parallel. And then where there's something uniquely enabled by crypto, we lean in there too. And so something that we do is called Know Your Transaction, KYT. Because the blockchain is open and you can look at what every transfer started and ended, where all the money moved, it's actually very easy. And we probably have best-in-class analytics, models, and so on to be able to track what money is clean and safe and what money do we not want to touch. And we can block at the start of a transaction the money ever even entering our payment systems, our products, and things like that. And so I think pairing what's uniquely enabled by crypto, which is the ability to monitor transactions and view the blockchain as this transparent ledger, with, of course, what's expected for any financial institution or working with businesses of this size, I think we can build a really amazing kind of compliant product.
That's a very interesting point of view. So what you're saying is knowing the transaction, not so much with the person, that also helps you implement compliance. Could you double click a little bit? Traditionally, if I was doing a payment over fiat, typically they would run a KYC and OFAC checks on both the recipient as well as the sender. Over here, you may not know the sender because it's just a digital ID, but then what do you check on the transaction? Could you just elaborate a little more there?
Yeah, what you can see, for example, is anytime fiat turns into crypto, there's a KYC or KYB moment. You can then watch the transfers from the moment that someone was KYC, KYB'd to get from fiat into crypto, and watch every string of transactions from then on. And you can trace effectively, is this money coming from a KYC, KYB wallet? Is it safe? Is it clean? Is this someone who we trust? Or did it come from a bad source? And you can, no matter how many wallet transfers the bad source goes through, you can trace it back to that source and effectively prevent the bad actors from entering the system.
This is super exciting. Something I learned today. Thanks. So, as you're doing all this, is this still achievable within the 250 milliseconds? Or you do something like a little bit of prep work? Yeah.
We do it all. So, of course, there's some prep work, but the money actually moves within 250 milliseconds. And when the money moves, it's moving. And so we typically do these screens leading up to the execution of the payment so that a bad actor can't even get the money to move, get to that moment of 250 milliseconds if they're using one of our products or one of our systems.
Got it. So let's switch gears a little bit, right? Let's talk a little more about the technology, the infrastructure, right? There's a lot of talk about L1 and L2, and L1's much slower and so forth. For someone who's uninitiated, could you give a quick, like a layers for dummies sort of thing?
Yeah, of course. And I think the question's a great one because what we need to do as an industry is not make our customers, our users even think about these things. We want to just deliver value regardless of where it settles, what blockchain it's on, what the network fee and token are.
Yeah, but there are a lot of nerds here.
Yeah. But I'll give you the answer nonetheless. The layer one blockchain is the primary settlement layer where all of the primary liquidity and therefore economic security exists. And because that's where we're finalizing transactions, that's where it takes longer and potentially more cost to settle a transaction because there's a lot of work going in to validate economic security. Again, these are blockchains, and so they're distributed networks. There are effectively these validators that run all across the globe who are ensuring that the blockchain is, we all have a common agreed and finalized blockchain. And so that can take a little longer and cost a little bit more. But for things like payments, we need the ability to settle much more quickly. We need the ability to have these fast performance and cheap blockchains. And so what you can build on top of this layer one is a layer two. And on top of layer twos, you can build layer threes. You can abstract it all the way up. And what it means is you're effectively running separate logic to validate that the transactions happening at the layer two are all valid. And then you take that bundle of transactions and you download it to the L1 to finalize and ensure finality and security of those transactions. And so effectively what it is a way to more quickly and cheaply validate transactions so you can move on with your day while bootstrapping the economic security of the underlying blockchain.
Thanks. A lot of our discussion so far has been more centered around faster payments, 24 by 7, 365 payments. As you look further out, things are going from not just faster payments, right? The next generation is more about smarter, more contextual transactions. How do you think stablecoins enabling those sort of smarter, more contextual payments for our users?
Yeah, so something I think is really interesting about the blockchain is that you have what's called a smart contract. You have these programmable units of logic and code that run at the exact same layer as the actual transaction itself. And that enables really interesting things. So one thing that we've built that we're really proud of is this auth capture protocol for consumer payments. We know that in order for stablecoins to work at checkout, they need to mimic the functionality we expect with cards in Web 2, which is the ability to separately auth the funds and then later capture them, void, and do whatever you need in that transaction so that we don't uproot the entire flow of funds of the businesses that we're integrating with. So we have this auth capture protocol, and what's exciting about it is it exists out in the world permissionlessly on the blockchain. So anyone else in the world can now go build on top of it themselves. They can fork it and build their own version. They can go build the Web3 native e-commerce. And that's really exciting. It's actually just code sitting on the blockchain that enables these transactions no matter who you are anywhere in the world. The other thing that's exciting is now people can build on top of it composably. And so an example of this is I just met a builder who is doing buy now, pay later on top of our protocol. And they're doing this by looking at the transaction history of a buyer. They're determining if they're trustworthy. They're giving them an under-collateralized loan and allowing and effectively fronting the money for a buyer so that they can then pay in full if they're buying something expensive on Shopify. And what's so amazing is that the builder was able to create this buy now, pay later app without ever consulting Coinbase, without changing anything about Shopify's flow of funds. The entire protocol is still the exact same and it's verifiable on the blockchain, but anyone in the world can now build on top of it and stack these Lego pieces together to create what we consider this composable innovation. And so I think that's the namesake of crypto broadly, is how do we take all of these component pieces, all these pieces of logic, and instead of them being gated by institutions and intermediaries, they're just out there in the open for others to build upon, create on top of. And I think that's where a lot of the innovation in crypto has come over the past few years, is just the ability for builders to pick and choose which Lego blocks they want to use, piece them together, and develop new use cases and solve new problems.
That's just awesome. Now, taking one more switch, there are a lot of stable coins out there, each on its own blockchain. And as, in fact, our own company, SoFi, recently announced being the first regulated bank offering stable coins on their platform and crypto. What do you think about how can your products enable interoperability between various blockchains, various stable coins, and crypto? Do you want to share some thoughts there?
Yeah, I think it's very important that we don't let the fragmentation happening at the chain level or the stablecoin level impact the end user experience. Of course, there is this gold rush for the interest yield. There's this gold rush for having your own stable. Of course, those things matter because that's where the user is, and owning the user is the most important thing for many businesses. But when we're delivering products like stablecoin checkout or payouts, pay-ins, treasury management, it really should be as easy as just calling a Web2 API. We really shouldn't concern our customers with which stablecoin they're using, which network, all of these things that are just going to make them averse to adopting these new rails in the first place. But to answer your question, what is amazing about crypto is it is all interoperable. And so as long as there's liquidity on the source chain, on the place where the initial currency exists, and there's liquidity on the destination chain where you're trying to move the funds, you can swap between them remarkably easily and, again, permissionlessly without any sort of central intermediary. There are these decentralized exchanges called Uniswap or 1inch or whatever it is that allow you to facilitate these transactions, and you can do it all programmatically. And so a cool example of this is our product. We allow customers to spend stable coins on a bunch of chains, and they all settle on Coinbase's L2 USDC on Base. And we can do that at effectively no cost to the buyer or to the merchant. It's all just bundled in our platform fee, because we don't want the recipient of the funds to have to think about what chain they're on, to have to deal with the liquidity issues there and so on. And so we do that all on their behalf. And I think that's a standard that the industry is setting, is just give our customers cash, right? Whether it's cash on the blockchain or cash in a bank account, they just want the word cash, they just want dollars. They don't need to think about all the nuances of the underlying chain, stablecoin, and so on.
Ooh. So we've talked a lot about past, where we are, and the very fast adoption in the last year. Let's just fast forward a year, or maybe if I was asking this question 3 years ago, I would have said 5 years. Now I think that seems an eternity. Just 12 months ago, ahead, or 18 months ahead, what do you think? I was listening to some podcast last night, and Mark Zuckerberg was calling out that within 12 to 18 months, he expects all code to be written by AI. Now, what do you expect in the payments world?
I think that the realistic assessment is that stablecoin becomes as commonplace of a payment rail sitting next to all the other payment rails as anything else that our customers come to expect. It doesn't mean that every single payment's going to transact over stablecoins tomorrow, but when I think about it, it really comes down to jobs to be done and enabling those jobs to be done for our customers. And if a customer is prioritizing global reach, or reaching a customer or recipient in a country they previously couldn't access, it's a no-brainer that they're going to want stablecoins in their payout or pay-in flow. Same goes for potentially settlement times. If the job to be done in this moment is I need to transact on a weekend or on a banking holiday or whatever it might be, stablecoins are also a no-brainer. But it doesn't necessarily mean that stablecoins are going to become the only payment rail and undergird the entire financial system overnight, because of course, if the job to be done is better solved by ACH, then of course we should ACH. But I think what we're seeing as well is the abstraction of all these complexities, of all these stablecoin rails, and letting an orchestration platform, letting the API layer just decide what's the best way to get that job done. And instead of talking about what rail do you want to use, just saying, hey, what can we accomplish for you today? And transacting accordingly.
Yeah, I like the way you're framing it, right? If you go 60, 70 years ago, credit cards, nobody knew those. 25 years ago, PayPal, nobody knew how digital online wallets would work. So probably in another 12 months, stablecoin will be just one more drop-down option. So that's great. One last question, and then probably I'll look for your closing thoughts. But when you're, as part of Coinbase, as you're working with Shopify, someone has made purchases using stablecoins or crypto, do you see any fraud where people report and say, hey, I wasn't the person who did this? Have you come across those scenarios? And if yes, how do you handle those? Or how does Shopify handle those?
Yeah, so I have a few thoughts here. The first is we certainly tried to mimic what works great about auth and capture in the Web 2 world with what we've built on the blockchain. And so we actually do move the funds into escrow, which means that there's no double spend problem. The customer can pay self-custodially if they'd like. And the funds sit there in escrow until the merchant delivers goods or until Shopify is willing to capture those funds on behalf of the merchant. And that allows them to do all the sophisticated business logic they need, guarantee inventory, or run their risk models on the merchant, and tax, shipping, all the things that they need. And they can easily void automatically after a certain period of time, or by calling our API again, anytime they please. So that's one way that we build trust into the system, is mimicking what works really well in Web 2, and also giving that buffer so that the funds don't go instantly to the merchant, in which case there is a likelihood that there'd be increased fraud or frustration. But to your point, I do think there is a need to build deeper consumer protection into crypto. These payments are irreversible. If you did get the good and Shopify released the funds and you weren't satisfied, you don't have an Amex to go complain to and dispute. Of course, Shopify is a phenomenal partner. They have very well-trusted merchants, and so they help intermediate some of those challenges. But there's certainly an opportunity to lean in heavier into consumer protection, and it's something I hope to spend some time on in the coming year.
Awesome. Thanks, Justin. I learned a lot. Any parting thoughts?
I really appreciate you having me. It's exciting to have stablecoins talked about at a conference like this. Again, Coinbase is really leaning in heavily here. We have a really meaningful payments business, payment acceptance, pay-ins, payouts, treasury, B2B. So if you're interested in learning more, we're happy to do education sessions, to teach, to listen. My name again is Justin Gainsley. You can find me on Twitter, on LinkedIn. Reach out if you're interested.
Will do, and definitely I'll take you up on those education sessions. Thanks a lot.
Amazing.
This is Prashant on behalf of Galileo signing off here. Thanks.
This podcast has been a production of Galileo Financial Technologies with all rights reserved. The content is provided for informational purposes only and is not legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information. You understand that any reliance on this information is at your own risk.